Hi, good afternoon, everyone. Hi, this is Dick King from Managing Partner of YTK Management Consultant. We are a firm, a professional firm providing accounting, taxation, as well as company secretary services. We have also, been advising all our clients on how to ventures overseas. So that is a little bit of background for myself. So today we are very happy to share with you on the budget 2020 highlights. I think as everyone know that Singapore for the first time has come up with four budgets. The initial budget, but because of the COVID-19, it come out subsequently three more budget to help the local business and entrepreneur individuals to tide over this difficult period. So which we are going to touch later on some of the highlights. Now, the agenda for today will be the impact on COVID-19, some of the budget 2020 tax changes. Now, these tax changes, some of the tax changes has been announced in the previous budget, but we are just going to recap so that everyone knows that what is in for them for this year. Now, we are going to share some tips on how to maximize your tax, how to maximize your profit, reducing the tax in this case. Some of the GST changes that will be happening, as well as the some of the government support to business and individual, and how government will assist to protect the business. Now, I think everyone knows in the last 2 months in this circuit breaker that Singapore GDP has actually contracted by 2.2%. Now, I think while the economy suffers a lot, especially the retailers as well as the B2C business, I think that is something that all the government around the world is actively trying to help their own economy to survive. Now, without any doubt, Singapore will probably enter a recession this year. Now, I read this morning Business Time, and one of the articles is mentioning say that the real deal will come after all the government support has been used up and after the circuit breaker. Then we will be able to see who is the one that has a larger cash reserve and which are those companies that is able to survive in this pandemic. Now, unemployment rate is also assumed that it's going to be rise in March 2020, and this is something that a lot of government is not wanting to happen, because when the unemployment rate increases, there will be less consumer power in the market, and therefore affecting the economy. Now, these are some of the impact on COVID-19 that we just do a quick summarize for all of you. All right, so I'm sure that the supply chain will be disrupted. GDP forecast, just as I mentioned, will definitely be decreased. And I'm assuming that a lot of you are also working from home, adopting a lot of digital solution in this case, to actively controlling your operation just from your home. Now, countries around the world will also be facing an economic downturn, not only Singapore. So that means that even though Singapore is ready to do business, but if the other countries are still in the lockdown or under like circuit breaker, they will not be able to trade with you. Material will be unable to import, and I think a lot of you suppliers out there are trying to find new distributor or even new supplier for your own product. And definitely paying the rental as well as the staff salary is an issue over here. I recall that one of my client recently actually called me up and asked me, so he said, can in this month or May we have the circuit breaker. Can I don't pay my staff salary? Because my staff is not doing anything, but they are just at home. But can I don't pay the salary? Because every month the staff salary will probably cost me about 30K. My answer to them is that the government in this budget later on, which I will share, they are already they are already trying to sponsor or support 75% of the cost through the job support scheme, which I will touch on it later. But the question here is, if you are not going to pay them the salary, definitely you are going to save, but save that amount of money. But when this circuit breaker is over, please do take consideration whether later on can you get enough labor or enough manpower to help you to kickstart your business again. Because let me assure you that after the circuit breaker, getting a work permit or an employment pass could be difficult because the government will probably want to reserve all the headcounts for the local. Now, let's start on how Singapore actually addressed to the challenges in this case. All right. First of all, I think they got two aims in this circuit breaker. First of all is to reduce the unemployment rate, and the other one is to reduce the loss of cash flow. All right, because as I mentioned just now, how are they? They will need to address to these two issues very critically. Otherwise, they can't save job. So in order to do that, they actually do some grants and support for the companies as well as the individual. They also implement laws to protect the businesses as well as also come up with deferment scheme for some of the tax payment. Now, these are the four budget that I was talking to you all just now. We have the Unity budget that was released on the 18th February, as well as the other resilient budget, as well as a solitary budget and extension of it in this manner. Later on, I think after the presentation, we will share out the slide. If you kindly able to fill up your request for the slide, we will then send to you. We'll send you via email. Now, let's touch a little bit on the Unity budget. I think Unity budget, when this initial budget was actually launched out, everybody was a little bit more excited. But later, COVID-19 comes in and hit the ground, and everybody was like focusing on what are the grants, what are the measures that the government is trying to help us to tide over this pandemic. But take a step back and let everybody start to think about it, about the Unity budget. All right, what is it in the Unity budget? What is the initial direction that the government wants us to go? All right, the initial direction that the government wants to go is that they want company to continue to expand their business, continue to have more cash flow. And how are they doing that? They encourage internationalization. Now, what is internationalization? Internationalization means that you try to expand your business overseas. You try to bring Singapore brand to overseas. All right, so that is what they are always trying to do. So in this Unity budget, they actually extend the double tax deduction for internationalization, extend the merger and acquisition scheme, as well as extend the company gain, certainty of the company gains on disposal of the shares. Now, I'll just probably want to touch on the first one first, because later on the merger and acquisition scheme, which we will touch on later, we will share more news with you all. But what is the double tax deduction for internationalization? I mean, if you have not been using this double tax deduction for your business, then you are missing out a lot of things. This double tax deduction for internationalization actually refers to when you go overseas to meet new customer, to penetrate new market, to introduce your existing customer, to find new customer. These are all your lodging, your accommodation, your travel expense. Up to 2% you can claim for a double tax deduction. That means that if you're incurring $1,000 for accommodation, travel, then you can deduct up to 2,000. That is double, 200% more. All right. Next is I'll jump to the third one first, because merger and acquisition scheme, as I mentioned just now, I will share with you all later. Now, especially when right now we are in a consolidation market, okay, where all the weaker players are being weed out, and the bigger boys are taking over the smaller boys. There's a lot of companies that are going to sell their investment or sell their subsidiary because they aren't making any money. All right, or they are making money, but because of this opportunity, they try to sell away and try to make a gain on this. Now, when you sell away your company, now the gain that you derive from the disposal of the investment may be subjected to tax by IRAS. So how do you determine whether is this gain taxable or not taxable? It bounces down to, is it a capital in nature or revenue in nature? Now, with this extent of certainty of the company gains on disposal shares, the safe harbor rule is that you need to hold on to the share for a minimum for 2 years. Then if you hold on for a minimum of 2 years, IRAS is more inclined to treat it as a capital in nature, and your gain will not be subjected to tax. Now, having to say so, it is not a 100% guarantee, but it is more inclined in this case, but they will still need to look at the circumstances, but less likely to treat it as revenue in nature. Now, the next thing here is that they also try to improve the cash flow, by adding another 2-month installment for the filing of the estimated chargeable income. They also allow carryback losses. Previously, the carryback of losses is only be able to carry back 1 year, but now they actually extend it back to 3 years. So this actually increased the cash flow, which we will see in a few examples. They also promote accelerated capital allowance and as well as continuing with the wages credit scheme. Now, this enhanced carryback losses to some of my friends here that is from overseas, you may not know what is carryback because a lot of companies has carry forward or losses. What is carry forward first? Carry forward means that if you have losses for this year in 2020, you are able to carry forward to 2021 to offset your future profit. Now, when you have this carryback of losses, this means that this year in 2020 you have losses, but in 2019 you have profit. So you carry back your losses to offset your previous year's profit. All right, you offset previous year's profit, and that will allow you to get immediate cash refund. Sorry, let me just re-emphasize here. This year you have losses. All right, this year you have losses. You are able to carry back to your last year profit. Now, with this enhanced carryback of losses, okay, it allows you to carry back your estimated losses back 3 years. Let me show you an example over here. Now, if you see from the screen right now, in the YA 2020, you have unutilized losses of 150,000 over here. Now, you have profit of 20,000 in 2017, 20,000 in 2018, 2019 you also have 80,000. So in this case, you actually carry back your losses and offset your previous year's profit, 20, 20, 60. And why is it capped at 100? Because that is the rule over here. All right, you will only be able to carry back 100K. That means you are leaving 50K of losses to carry forward instead of the 150. But what does this do for you? If you see over here, originally you probably have to pay some tax over here. The total tax payable for the all 3 years will be amounting to 6,503. But because you carry back the losses previously, all right, then this means that you reduce the chargeable income. In this case, you receive an immediate tax refund of 5,004. All right, so this will help the business or the companies to have this extra cash flow to tide over this period, especially at this period where where we in the coming months of November, where all the company are supposed to submit their Form C and tax submission. This will result in the IRS asking you to pay for your taxes. So these carryback losses will definitely assist you to make full use and get the immediate cash refund. Now, for these tax changes in YA 2020. Now, some of the tax changes over here has already been announced in the previous budget, but it's going to take effect in this year. So that's what I'm going to show it to you right now. Okay, I think as everyone knows on the partial tax exemption for most of the company, currently take note about here before YA 2020, the maximum that you can claim is 152,500. Now from this year onwards, the maximum that you can claim is only 102,500. All right. So where is the changes? The changes lies with they actually take out 100K from this 50%, resulting to only 190K. So that means that you need to pay an additional tax payable of 8,005. All right. Now, how about the new startup exemption for companies that previously set up in the last few years? You get to enjoy 100% of the first 100,000 that you make tax-free. All right, 50% of the next 200,000 is also tax-free. So that gives you a maximum of 200,000. Now, from this year onward, from YA 2020, which means those companies that just end the first financial year or end the financial year in 2019, right now you will take note, not instead of 100%, right now we only have 75. 75% of the first 100,000 is actually exempted from tax. 50% of the next 100,000, they actually took out 100,000 from here. So that maximum relief that you have right now is only 125,000. So that means that for some entrepreneur, all right, you definitely have to pay some tax right now. All right. So you see over that will give an additional tax of 12,750. Now, previously, why is this rule happening? Previously, I have customer that comes to me and say that TK, as a tax advisor, I know you definitely understand what is a new startup exemption. Now, in this case, this new startup exemption is given to the newly incorporated company for the first 3 years. In this case, can I start the company for first 3 years? Then at the third year, I close the company down and I start another one. And in this case, every 100,000, 100% of my first 100,000 will always not subjected to tax. Now, IRS has come back, and this is just one of the solution to curb this tax abuse. So they're saying right now here is 75% of the first 100,000 is actually exempted from tax. You've got to pay 25% at least on that. Now in YA 2020, there is also corporate tax rebate. All right, the 25% tax rebate capped at 15,000. All right. So ladies and gentlemen, we are here to tell you more of the tips to maximize the returns. Okay. So how do you do that? Okay, for some of the individual, all right, for some of the individual, you can actually set up and contribute to the SRS account. Now, for some of you, if you don't know what is SRS account, you can text to me later or email to us later, and we will glad to share with you on the SRS account. All right, and at the same time, you can also approach your financial advisor regarding the setting up of SRS account, because any money that you put into the SRS account, that could be tax deductible. Next thing, it will be topping up of the own and family member CPF account, and of course also attend the courses that are related to the work development. You can also, if you have no place to spend your money, do consider donation, because donation will allow you to have about 2.5% tax deduction. All right. So at this stage where there's pandemic, do think about the needies and contribute. If you have excess cash, nowhere to spend, please donate to the IPC. Now, for some individual who owned residential property, all right, you can claim the rental expense based on the 15% of the gross rental income. Okay, previously, what happened here is that IRAS is always insisting on the actual expenses, which means that they must see the invoices, they must see the supporting evidence before allowing you to claim. All right, of course, in this case, it's only upon when they ask for. Now, but right now in this year, they actually says that you can claim rental expense based on 15% of the gross rental income without showing the receipts or the supporting documents. So you need to weigh and determine, should you do an actual or should you do a 15% blanket over your gross rental income to claim. Now, for some of my friends who are the PHV or the taxi driver out there, all right, you can claim 60% of your driving income as your deemed expenses or the actual expenses. Now, for this special group of friends over here that has also been out there slogging, as driving around, previously they are not in a very good shape, not in a very good situation. Why? Because private car expenses are non-tax deductible. So that means that they incurred all the fuel costs, the maintenance of the car. These are not allowed to claim. All right, these are not allowed to claim. But because of they themselves are the taxi driver or the PHV, private hired vehicle driver, right now IRAS allows you to claim 60% of your driving income as deemed expenses. So do take note and make full use of it, unless that you have your actual expenses is actually more than 60%, which most of the time I doubt so, because some of you came over to me and asked. I would think that claiming 60% as a deemed expenses will probably be the best way up for you all. Now, for financial advisor or the property agent or who is a commission agent, you can claim 25% of your commission income as expenses or based on the actual expenses. Now, the commission income in this case that you receive should not be more than 50,000. Now, for those individuals that receive commission income more than 50,000, now this rule may not be applicable to you. You probably need to claim based on your actual expenses. So you got to do a little bit of planning once in a while. For married individual who wants to have a baby, all right, you do remember that you have parenthood tax rebate. Okay, there's something that you can use to claim to decrease your tax. The personal tax relief over here is also capped at 80,000 right now. Now this will actually affect the mother that has a gross income that more than 100,000 and have 3 children. Why is this so? Because previously when we have women that or mothers that has a high income earner, all right, and because their kids are still relatively small, okay, the working mother-child relief allows them to claim a lot of tax relief. The first child is already at 15%. The second child is at 20. The third child is 25, and and the fourth child is already at 25. Can you just imagine every percentage that adds up? In the end, the working mother who is a high income earner may end up paying very less tax. So our IRAS government recognize this, and therefore the tax relief is actually capped at 80,000. So that means that even though you can claim 15%, 25% for all your children, is still capped at 80,000. Now, what does this mean? Let me take a look at the example over here. The employment income is actually 100,000. All right. Now, the working mother-child relief will come out to be about 60,000. CPF contribution is actually at 20. All right. So that will give you the 80,000 relief. That means if you are claiming also additional qualifying child relief of 12,000, as well as parent relief of 5,005, this relief here will be forfeited, which means that you are not making full use of it at all. So if that is the case, I would suggest that you give your qualifying child relief to your spouse, your husband, all right? And at the same time, give the parents relief to other siblings or your spouse so that, they could make full use of the relief and also reduce their tax since that you have hit your 80,000 cap, okay? It's not necessary for you to top up your CPF or SRS account because that can't give you any benefit too because you are already capped at 80,000. All right, we will continue. So do remember to post your question at menti.com because I'm speeding up on the slide because some of these slides are actually a little bit more dry. So I will be more happy to answer your question later. So let me just go on to the next segment on the goods and service tax. Now, the goods and service tax wise, for my foreign friends out there, all right, so this is referred as the VAT in your country. So it will increase from 7% to 9% sometime in between 2022 as well as 2025. The government, because of the COVID-19, the government has come in and says that they will not increase the GST at this period of time, but they are still abiding to this decision that to increase it to 9%. But we just need to wait and see and see how this thing is going. Now, GST on the imported services in this case. Take note here under if you are doing any B2B electronically or B2C, all right, these are the GST that is the GST treatment that will be affecting you. Okay, so in this case for B2B, the reverse charge, take note of the reverse charge implementation as well as the overseas vendor registration for the B2C. Let me explain to you in a short while. Now over here, on the reverse chart. Now just imagine over here the customer in Singapore is going to pay 7% GST to company A because company is providing the service. Now, but for company B over here, company B was not a GST registered trader in Singapore. So they are also be able to provide the equivalent service to the customer. In this case, I think as all the businessmen out there, we will probably choose to, pay the money to the company B that is in overseas, because we no need to pay the 7% GST. Now, if you see over here, the market condition, the factor that is affecting your buying decision lies with the 7% GST. In this case, IRAS don't want this to happen. All right, so they are saying that you need to do a reverse chart, which means that if this is the case, the customer himself, they will need to account for the GST and submit to the IRAS in this case. All right, so the Singapore company will need to account for GST as though he is the supplier, but this reverse chart will only apply to the partially exempted business. Now, partially exempted business means that you have other form of supply, not only on taxable supply, you have other exempted supply such as from financial services, income from financial services, interest income, or exchange gain or loss. So you are considered under reverse charge in this case. Now, for overseas vendor registration, which some of my clients actually asked me about, is that if you have a global turnover of 1 million and making B2C supplies of digital service to the customer in Singapore, and these supplies exceed 100,000, you are required to charge GST. Okay, some of this will probably be Netflix, or if, for example, Microsoft Office, Amazon, or some e-commerce companies that are selling via online to B2C. Take note, all right, if your global turnover is 1 million and you are selling to Singapore is exceeding 100,000, you need to register for GST in this case. You may need to also register, under this overseas vendor registration scheme.